Hi, this is Randy Finney with Right Side of the Chart, and today's Wednesday, February 21st, 2018. I wanted to do a recap of the broad markets, take a look at both the near term and the longer term outlook where the markets might be headed. And in doing so, we'll look at the major indices, the S&P 500, the Nasdaq 100, and we'll go through the sectors of the S&P 500 quickly. There's only 11 sectors in there, and so by doing so, it can help you get a better gauge as to not only where the market might be headed, but I believe going forward, and I stated this, heading into the year, that I think 2018 will be much different from 2017. I think this year will be both a stock traders market or stock pickers market, meaning not a buy and hold market. 2017 will go down in history as one of the easiest buy and hold. Put your money in an S&P 500 fund and let it ride, and or just about anything, other than certain commodities had a tough time. But we're talking about the broad market. So most sectors rose, and it was a very steady grind, record low volatility, and I expect the opposite to happen in 2018. So far, that's been the case. You'll see probably continue to see that going forward. A lot of sector rotation, meaning find out what sectors look promising. Go long those sectors, but don't get married to them. When the charts say get out, you get out. You make whatever it is, whether it's you're targeting 5, 10, 20, 30%. And the same thing with individual stocks. So that's what we call a stock pickers market versus a buy and hold market. So I think we'll see sector rotation and asset class rotation. If you remember the site, you're probably aware that the official trade ideas on the site now and heading into the year have been a mixture of both stocks, individual stocks, ETFs, sector ETFs, but as well as commodities, precious metals. So we have gold, we have various agriculture commodities, and even a bond ETF as a trade idea for them. That's the first time in a long time. I typically don't trade bond ETFs. There's not a lot of meat on the bone there, but so therefore, what that does, it helps you, whether you're an active trader or an investor, asset allocation, diversification, that is the key to long-term success in the market. And again, I think those same premises apply in both swing trading on a shorter term time frame that might only be, weeks to months, as well as trend trading and longer term investing that where you're positioned for many months or more. All right, so here's the S&P 500. A quick recap of what's happened. We had this bearish rising wedge with divergences in on all the major indices. Right now, I'm just looking at the SPY 60-minute chart. Back here, I believe it was on this January 29th, posted we had a sell signal on the U.S. stock market's first sell signal in a long time because we had breakdowns of these trend lines that I was watching on all three of the major large cap indices, the S&P 500, the Nasdaq 100, and the Dow Industrials. So they all broke down, gave us very clear sell signals, told us, that was time to, take some profits on longs, get short, and that was followed by a pretty swift correction. It was a function of the volatility, short volatility trade unwinding, extreme low short interest, extremely high bullish sentiment, everything else, and that's why we had such a swift correction. We bottomed, again, this is just a recap here. We had a divergent low, as I often say, during, sharp trends or even slow, steady grind uptrends. As a swing trader, one of my favorite time frames is 60-minute chart, and I like to look for divergent highs and lows on the 60-minute time frame to position for swing trades. So that's what we did here. We got that retested the lows. It looks like we undercut them quite a bit here on the SPY, but when I'm not pulling this chart up right now, but on the futures, it was more of an equal low on the S&P 500 futures. We had the same thing, divergent low on the Nasdaq 100, and again, that was our time to go long. We'll get to the weekly charts in a second. As I said, most importantly for the longer term investor, as well as the shorter term swing trader, those long term trend lines we're going to get to in a second held. I'm going to go over the long term chart. So right as of now, and as I said before, the bull market is still very much intact. We had some intra-week violations of some key trend lines, but as I said at the time, before it happened and after it happened, that it doesn't matter if you break those weekly trend lines intra-week. All that matters is how you close. So we're safely back above those. And now where do we go from here? So let's just take a look. Here's the S&P 500 again, 60-minute chart. This may be flagging type action. It appears to be that way. You have a potential bull flag here. Yeah, you already had a period of consolidation here, and so this gives me a little bit of pause um, because you had this swift move up in what appeared to be a bullish pennant and a breakout. So that pattern has already been met. Is it possible to have a bull flag and right after bullish pennant has played out? These are essentially the same patterns, guys, by the way. A bull flag just has that shape of a flag, that downward shape, where a pennant, obviously, as the name implies, is a pennant. But if if this does play out to be a bull flag, what you want to look for first of all is a breakout, impulsive breakout, meaning on the volume expansion, impulsive price action. And if so, the projected or the measured target for a breakout of bull flag would be the distance of the flagpole, which is this move out of the pennant, just as this was a flagpole leading up to the pennant, and you add that to the lowest part of the flag. And that would take us right about to maybe a little bit above the final target on SPY right now. You can see the other day, was it Friday? We hit almost to the penny. It actually right about the penny to the resistance line. I always set my price targets on longs a little bit shy of resistance, just in case the sellers step in early. And you can see, this was a line that was placed here, way back when on January 10th, and we hit that line on February 16th. So not witchcraft, not voodoo, just good old-fashioned technical analysis. So that's where, at that point, I said a pullback was very likely. On Friday, suggested that some shorter term traders might want to close out some positions. So if you did, or book profits, then you avoided the pullback that we had since. So now where we go from here, again, I just showed you there's a potential bullish scenario. Um, but I want to say this, we're not out of the woods yet. I still do favor, I am still near-term bullish, or I wouldn't leave this final target on that trade right there. I think that gets hit, and I'll get to my longer-term scenario. I still think I'm leaning towards the scenario with more upside and new highs, a resumption of the bull market. So I'll get to that when we jump out to the daily charts. But there could be maybe the market wants to work off the near-term overbought conditions a little bit more. You can see that we, had a pretty sharp rally off the lows. That was on the SPY alone, and remember the futures were a lot more. That was almost 9%. So it wouldn't surprise me to see us go down as low as this resistance support zone. And if you're looking to buy a dip, well, this former first target zone, T1, was placed just below this support zone. That was, as I mentioned before, a natural support level because that was a former resistance becomes support once broken. So therefore, that's what's actually contained this pullback so far. You can see perfectly. You can see a 60-minute candlestick with a little shadow down below the tail, only to hammer right back above that bottom of that support zone. So TA, as I often say, technical analysis works extremely well during periods of high volatility because that's what traders flock to. Even the fundamentalists that typically, fund managers that base off fundamentals, if they're looking where to buy, where to exit, things are getting a little rocky. You don't turn to a company's spreadsheet at that point. You turn to the charts to determine your entries and exits. So that's my theory as to why TA works so well during periods of increased volatility. So it's very lucrative if you're an active swing trader trading these index funds, even futures, the E-minis, anything like that. So there it is, guys. I just, I can't rule out. I'm telling you, probably 50, little less than 50-50 that we get another thrust down here to that support zone, then a continuation of the uptrend. But we could continue on from here, and we'll just have to assess things as they go. Again, this is the final target, but this was more to catch a bounce trade here, and then we'll kind of step back and see what the charts are doing. Possible that I extend the price target on this trade, but at this point in time, I'm not doing that. So let's just take a look here at some other things. Daily chart. This is the scenario. This is the scenario I laid out even before we bounced, if I'm not mistaken, either back here or maybe when we were bottoming. I laid out a scenario which is still my preferred scenario. Doesn't mean we have to get it. It's just what I think will happen if I had to, you know, lay a big bet on the market and turn around and walk away. and I couldn't trade for a couple months, this is a scenario I would bet. Now, fortunately, we don't have to do that. As a trader, you have to stay flexible, nimble. If the charts tell me otherwise, well, I'll adjust. But this is what I think is probably going to happen, and I would love to see it happen. And that would be, as I mentioned before, market goes on to make a new high, what I call a marginal new high, nothing super high. And the reason is if we just blast on up through there, a lot higher, we'll take out what would be potential divergences. Now, as I started the video, I said I'd love as a swing trader to see the divergences on the 60-minute time frame, divergent high and divergent lows, to position for swing trades, trades lasting at least a few weeks, if not several months. And I love to see even more positive and negative divergence, or I should say divergent highs and lows on the daily time frame. So, and I could certainly see this one playing out. It meshes with a lot of things that I'm seeing out there right now. Many factors that I just can't even get into here, but that would show, give us a move to new highs. As I said, bullishness would be through the roof at that point. Once we if the market recovers, and I think it will, this recent correction, the bull train will be just as loaded and crowded as it was when we were, here at the top of this rally at the end of January. And that would pave the way for this scenario. Big move down, more than that correction. If we get that divergent high on the daily charts, it would look something like this. You can see steep negative divergence here. If the market continues in the coming weeks here to make a new high, we'd be guaranteed to have negative divergence. And again, you don't get that often. And if you get it this late stage in the game, we're certainly in what's most likely the ninth inning of a bull market. This one has exceeded or has come close to any historical um, long ranges for both the economic expansion, the duration of a bull market. We are certainly at the long end of the historical ranges there. So that's it. That's the longer term scenario. And again, we'll need the 60-minute charts and even the shorter term intraday charts to be our guide. But as I wanted to just say this once more, we are not out of the woods yet. Um, there's still a couple things that I'm watching here. As I said, let's see if this advance continues. Let's see if we break out of that 60-minute flag. Here's a few items to note down here on the 60-minute, or I'm sorry, on the daily chart. One thing that I look at is usually when you see the RSI move from an oversold reading, like we were oversold right here, or overbought, and you get a sharp move down, the 50 level, which is that dotted line in between on the RSI, you have the red line as an extreme 70, which anything 70 or above is considered overbought, while 30, which is the blue line, is considered oversold. And right between there, you have the 50 level right in the middle. And it's very often or very common when you have a move from the top or the bottom on the initial tag of that 50 level, like I've noted with these arrows, you get a test of the 50 level. So we were deeply overbought. We went from oversold. That correction took us from extremely overbought all the way down to oversold in just a matter of weeks. And now we've bounced back and we're testing that 50 level, just as we tested it here from above. You can see all the tests in the past. So that's one thing to watch. And it also looked like we're poised to make a bullish cross on the PPO here, and that would help the bullish case. But sometimes you get a rejection when the lines try to cross. Here's one back here, for example, that just stands out. You can see the PPO line hit that signal line and then fell back down. So we don't have that crossover yet. Just something to keep in mind. So like I said, we're not out of the woods, but still cautiously bullish at this point. Let me just keep it that way. And if we start to reverse, we start to do some technical damage, then I'll try to update or convey my thoughts as soon as possible. Fibonacci's, I mentioned this before. You can see this line right here from the recent highs. This correction dropped. So far, the S&P 500 has stopped cold. Not cold. We pierced it intraday, but that is where we have failed at, and we remain below the 61.8 Fibonacci retracement. That's a key Fibonacci retracement level. So, let's see if we can take this out. That would be healthy for the market. So these are some of the things I'm looking for. Do we get a bullish crossover here on the PPO? The MACD would probably look similar. It's a cousin of the PPO. Um, do we cross back above the 50 level, and do we take out that 61.8% Fibonacci retracement? Again, Friday, my reasons for taking off booking exposure on my market longs, broad market longs, Nasdaq 100, S&P 500, was manyfold, but again, those reasons were stated. Oversold at resistance, which was a target, expecting a pullback. I shouldn't say oversold. I meant to say near term overbought in the very near term, not long term. When you look at this chart, we're right now not even close. We're in the middle right now between on the daily chart between oversold and overbought. Okay, so what we're doing is we're working our way out longer term. So this is the part probably that you longer term investors and traders, people with 401k money, these charts are much more relevant to you. This is the S&P 500, at least via the SPY, the tracking ETF. If you put up the S&P 500 index, it would look almost identical. We have a very well-defined uptrend line, just like we had an uptrend line off the 2009 lows. It was broken back here. Again, I've covered all this in recent analysis. We had a what we call a deer market, a sideways market for about almost 2 years, where the market grinded sideways after breaking that trend line, and then broke out here, and we had this next advance. So this is the trend line to watch. This is the what I refer to as the primary uptrend line, the S&P 500. It comes off the early 2016 lows. It's had several reactions, and as I said at the time, most importantly, we broke it intra-week, but we managed to regain that trend line, close back above it, and we remain above it. And as long as we're above trend, and all my long-term trend indicators are still bullish. So we are still in a bull market. And as much as I know there's a nice bear market not far around the corner, most likely in 2018, that'll start, maybe 2019. Until then, you can't fight the trend if you're a longer-term investor. And S&P, we'll look at the Qs real quick too. QQQ, same story. QQQ, that trend line started actually all the way back in 2015. You can see very well defined. It's really a price channel if you look at these two lines. So there it is, intra-week break. We hammered off that. I mentioned at the time we had that key 40-week moving average. The 40-week EMA is the same as a 200-day moving average. You can see that the QQQ reversed right above that. That's a pretty significant level. And most importantly, close back above trend, and that's where we are. So there it is. Bigger picture. If and when these trend lines go and we close below on a weekly basis, and we see all the major indices break down, the Nasdaq 100, S&P 500, the Dow, and you start to see those trend indicators roll over. At that point, you might want to revisit your equity allocation in your long-term accounts. I'll run through these quick. This is a list of the S&P 500 sector holdings. I'll just go through these. We're on the weekly time frame. I just jumped over from the broad market, so we'll stay there. I'm going to move this to the left of the screen as I click through. There's only 11 sectors, as I mentioned, the S&P 500, and I'll give you my thoughts on these again. For two reasons. Number one, to confirm where the trend is, where we might be heading, and also to kind of give you an idea what sectors are hot and which ones aren't so hot right now or don't look so hot going forward. And it doesn't matter what has happened already. You want to position for what's about to happen in the next few months. So here's the financials, XLF, and you can see they're still well above trend. They didn't even violate. In fact, all they did is test. They came in to test the trend line. So right now financials are looking good. However, there's negative divergence on the weekly time frame. Just as we had negative divergence back here, that resulted in a 27% drop in XLF. Back here we had negative divergence. That divergent high was followed by a 36% drop. I have the utmost degree of confidence that at some point in 2018, can't tell you if it's the first half or the second half of the year, we'll probably see this trend line break, and we're probably coming back down all the way here to at least that 2292-ish level. From where we're at today, that would be a drop of about 21%. But again, there's absolutely no sell signals on this time frame. I'll wrap up with, if there's time, we'll look at the daily charts real quick, and I'll give you the weightings on each of these sectors, how much they affect the S&P 500. So there's the financials, well intact, well still within a bull market. XLY, that's consumer discretionary ETF. and you can see a very well-defined trend line here. I made note here we didn't have divergence, but you had an extreme overbought reading, 20% correction. We had an extreme overbought reading. It was a pretty healthy correction. Let's see if I can grab the highs there. That dropped about 11% so far, but we're still above trend. Um, Again, I can see a little more upside in a lot of these sectors because these sectors that I'm going through, remember, these 11 sectors that I'm covering comprise the S&P 500. So if my scenario that I just covered for a new high in the markets play out, you're going to have to see a lot of these sectors, or at least the heavier weighted ones, make new highs as well, or that scenario doesn't pan out. So there it is. So you could see maybe the possibility another thrust up in XLY, followed by a divergent high. And again, watch this trend line. XLI, this is the industrial Spider Select Sector Industrial ETF. There was another one that intra-week had a violation of that trend line but snapped back up. And again, the only thing that matters when analyzing the weekly charts are the weekly candlestick closes. So this one held trend, extremely overbought, and no sell signals there yet. XLU, I'm not, I have a couple trend lines. You can see this white one as well as yellow trend line. We're below that white trend line. We're above the yellow trend line, but I'm not crazy about either of those two. Let me just say that. You don't have to have a trend line drawn on every stock or every index. And if I don't have a lot of reactions and can't make don't have a high degree of confidence, I'll let you know. So I'm putting a little more stock in these horizontal levels here. I see support down at 45, 42, and let's just get off that one. We'll look at the daily chart in a second if there's time. XLB Basic Materials, another one up above trend. There's the trend line I have drawn. Lost it intra-week, but regained it, so we're looking good there. Got very overbought, overheated. So again, the correction we just had. Um, was very healthy, if you will, for the market, at least for the intermediate term, for the bull market. If you want to see this bull market continue, you just can't have extreme overbought readings, extreme bullishness. The more that goes on, the more extreme all these readings get, overbought, extreme bullish sentiment, extreme low short interest, extreme low volatility. The more that those extremes increase, the greater the chance for a complete and utter crash in the market. That's what you get. So it's good that we got checked, and it's a good thing that we only dropped about 11% or so in this correction that we just had, and it helped clear out a lot of that excessive and those excessive sentiment and the extremes. So like I said, that paves the way for another advance in the market, in my opinion. XLK technology. This is the largest sector in the S&P 500, and it's over half of the Nasdaq 100. And as you can see, another stick save. Stick save meaning you have a candlestick that during the week was below trend, but managed to close the week back above and finalize that candle above trend. And so there it is. Not much else to say until that breaks. XLK is above a very well-defined uptrend line. XLV is healthcare. I have a couple different trend lines. We're flirting with this one right now. We regained it. We're right on this trend line. Quite a few reactions. I think it's valid. And then I have another one down here if that breaks. So this one's looking a little precarious. Needs to snap back up in there. If not, we could probably come down here and test this trend line. That's healthcare. XLP, consumer staples. Trend lines aren't so clear on this one. I have one right here that was recently broken, regained. Now we're back below it. So really you can focus on these levels here. Um, that's consumer staples. Don't have a very strong opinion. XLRE, I've been using for the S&P 500 because it is Standard and Poor's. It's their index. I use the spiders. Those are their ETFs, but that track their indices, I should say. But in real estate, I have to go back to IYR. It's traded much longer than XLRE, which is the spiders real estate ETF. So here's IYR flirting with this trend line now. It's still above trend. And again, we'll get to the daily charts here in all of these. But remember, XLE, we just only have a couple years of trading history, so I don't have really a lot of annotations on my weekly chart here. XLT Telecom, eh, I don't have a strong opinion on this one. It's just kind of grinded around sideways, as you can see here. Broke below trend, snap back above it. So this support, or not trend, I should say. This was a trend line. This was a breakdown of trend and back tested the trend line. Since then, it's grinded sideways. It had a support level here, and that support level has now been sliced through so many times I wouldn't put a heavy weighting on it. This is just a sector that is consolidating. It's in a sideways, grindy, sloppy trading range. If you're long any telecom stocks, you're most likely to get chopped to pieces. At least you have been for the last few months, and we'll see what happens going forward. So. XLE, another chart that's a mess. Energy's been a mess. Crude oil's been all over the place. However, this has been a very lucrative trade. This is a weekly chart. We go to the daily charts, and we have had probably more, successful and profitable trades on the energy sector ETFs. That's XLE, XOP, XES, than probably any other sector this year. Well, marijuana and gold stocks we've done very well too, but XLE has been a great trading vehicle. But when you look at the long-term charts, it's really a mess. So now let's see if we have time here. We'll go to the daily charts real quick, wrap this up. XLE dancing above support, not looking so hot. XLE is a 6% weighting. Let's go to XLF. There's XLF daily chart. I told you the weekly was fine, so is the daily. XLY, I'm sorry, consumer discretionary. Here's a trend line. We broke down and we're back testing that. So we could roll over there. That's one to watch. I'm not so crazy on this one right now. Um, don't have a strong near-term opinion. And I'll tell you right now, I don't have a very strong near-term opinion on much of anything. And that's why on Friday I closed out my broad market shorts. And I'm sorry, I should say I don't have much of an opinion on the broad markets right now. There are other individual stocks. And in fact, that's what I'm going to put my efforts on this week is revisiting my watch list, combing through a lot of charts, and finding trade ideas. And most likely there'll be individual stocks and sectors, including commodity ETNs and things like that. We'll revisit oil, precious metals, and all that other good stuff. So, anyways, we can go through all this stuff, but let's wrap it up here. The video's long enough. The charts, the daily charts. Since my opinion isn't super strong on any of these sectors right now, I'm just sort of watching the broad market, seeing how aggressively the buyers continue to step in here and buy up this dip. I've given you my near-term thoughts, and if anything changes, I'll try to convey those thoughts. My change in my outlook for the markets as soon as possible. But as of now, the near-term bias appears to be up, maybe a little more pullback. But if we break that bottom of that resistance zone on the 60-minute chart, especially impulsively, and a close down below it, then I will become concerned, and it'll appear that this rally may have fizzled out, and new highs might not be in store anytime soon. That's just, again, one of many scenarios. Maybe this market wants to grind around for a while, but let's just stick with the primary scenario at this time, which is more upside in the coming days to weeks. All right, this has been Randy Finney with the right side of the chart. Hope you enjoyed it.